All right, so let's start. Then maybe later they can join us. All right. Any question from our previous meeting? Do you have anything? Any question from our previous meeting? Let me know. All right. Since there's no question, then we can move on to our purpose of today. So today we'll be looking at security analysis concepts. Right? How investors and security analysts, how they analyze the trend in the movement, the trends and also the movement in the price in order to determine how a stock price is to be determined in the future. All right. So today we'll be looking at two basic analysis. We have the technical analysis and also fundamental analysis. These are the two main ways of analyzing security. We have the technical and also the fundamental. When we talk about security analysis, it's the process of finding a value for a stock. You determining a price for a stock based on available information, whether based on past trend, whether based on an estimate or forecast. Each one will form under one of these two. And at the end, we are going to look at efficient market hypothesis as well. All right. So what is technical analysis? Okay, I've not written anything there, but can someone help explain technical analysis based on the graph I've presented here? What is technical analysis? How do you understand technical analysis? Anyone to help? All right, we just said that analysis, security analysis talks about or the process of finding the value for a stock. And I said we have two main approaches. We have the technical analysis and also the fundamental analysis. And I've just presented a graph to you and I'm asking what is technical analysis? Can someone define technical analysis based on the image I have presented here? Does it ring something to you? Are you there? Can you hear me?
Yes, dog.
Anyone to help? Okay.
Hello, dog.
Yeah.
So I think the name speaks for itself. That the technical analysis is one of the ways to evaluate the prices of stocks or determining the prices of stock. In other words, you to predict the future prices of stock.
So based on this, it means that the technical analysis talks about the trend based on they use charts and diagrams to predict the future prices by looking at the movement, the up and down movements that occurs in the stock price to determine or predict how the stock price will be in the future. I hope you get it. So the technical analysis is based on chart and graphs. They use charts and graphs to predict the prices. Okay, so analysts and market technicians examine price and volume data as well as other market related indicators to determine how the price is going to be or to forecast the future prices of the stocks. Okay, so as I said, technical analysis places much emphasis on chart and graphs. Okay, they place much emphasis on chart and graphs in order to help predict how the stock price is going to be in the future. Okay. So they typically use market indicators in order to measure the strength of the market or the economy. See, so when there's an upward increment based on the chart, if the chart keeps moving up, it sends a signal that the stock market is performing well or the value of the stock is increasing. And as such, there's going to be an increment in the future price. But when there is an upward or the downward trend, it means that the stock price keeps on dropping, and it sends a signal that the share price for the future might not be favorable to investors. Okay, so based on this, and they predict how the stock price is going to be. All right, so these are some of the assumptions of technical analysis. Okay, so one, market value determined by the interaction of demand and supply. Okay, they based on the interaction of demand and supply. It's also assumed that though there are minor fluctuations in the market, stock prices tend to move in trends that persist for a long period. Okay, so if there is a trend that may be from January to February or January to April, it has been a persistent trend, you can predict that from May to June too may be the same because there have been a persistent trend. That is one assumption of the technical analysis. It also reveals it's a reversals of trend. Reversals of trends are caused by a shift in demand and supply. So this is similar to the first assumption. So shift in demand can be detected sooner or later in charts. If demand is increasing, the chart will go towards a specific direction, and the vice versa too. And many chart patterns tend to repeat themselves. Okay. So imagine you are at analysis or a chartist and you want to determine the stock price of maybe, when it comes to Ghana Stock Exchange, the price doesn't move. The graph, let me use the graph. The trend, there is no trend. It has been persistent. It has been at the same point for so many periods. I don't know if there is anybody trading on the Ghana Stock Exchange that will want to share whatever I'm saying. The prices does not fluctuate. It keeps on being on a horizontal line. It doesn't, you don't see the trend, you don't see the fluctuation, the ups and downs. It can remain the same for a longer period before a minor change will come in. I don't know if you get what I'm trying to say. Before a minor change will come in. So all this, so many chart patterns tend to repeat themselves. So you can, from January trend, you can predict what will happen in February, you can predict what will happen in March, but there have been a persistent trend in it. All right. So tools for technical analysis. We have the primary trend and also the secondary trend. So the primary trend is the long-term movement of prices lasting for several months to several years. Like what I just explained on the Ghana Stock Exchange. Then there is a long movement in the trend. That is what we call the primary trend. And the secondary trend are more of intermediate. So they are caused by short-term deviations of price from the underlying trend line. So goes up small, it comes down. Like the previous slide, as you can see here. These are the trend. If you see trend in prices, this is how it looks like. Okay, it goes up, it comes down, it goes up, it comes down. So when there is a long, okay, can you see my Kaiser? I don't know if you can see. Can you see the Kaiser?
Yes, we can see it.
We see this line. It looks of more of a primary trend because it has persisted for a longer period. But when you look at something like this, the red line, it goes up, then it drops a little, then it goes up again. So this is what we call the secondary or the intermediate trend. All right. Okay, so what are some of the advantages of the technical analysis? Is it even advantageous? One, it is objective. You based on trend to predict what will happen tomorrow. So it makes it objective. Based on available information, you're able to predict what will happen in the future. But there is data available on the market to help you analyze using softwares in order to predict, what will happen tomorrow. So that makes it objective. So, and it makes actual investment easy. As an investor, you need to have an idea about how this market operates. All right. That is why some of them employ the services of a broker. And you know the points to consider when choosing a broker, remember, right? It must meet the investment needs of the investor, and it must also be known on the market. It must be knowledgeable in the field. So all these are some of the points they consider before they choose a broker. 2. Technical analysis is easy to learn and requires no specialized financial knowledge. Okay, it does not require much financial knowledge to know how to conduct technical analysis. Technicians have access to all information they require in the analysis. You can easily predict the movement in prices of a security or a stock on the market based on the past trends, because they might have past information there from maybe 2010. You can analyze how the movements the stock have been. You can analyze from there and know how it's going to be in the few coming years. All right. You also have some criticisms. Okay, the most evident one is the controversy over the efficacy of its strategies. So opponents of technical analysis claim that there is no real objective as assumed under technical analysis. Substantial evidence that it works. Indeed, the weight of information supporting the weak form of efficient hypothesis rejects technical analysis. Okay, so there's no much information to justify, or there's no substantial evidence that past information can help to predict future information. That is the criticisms they are putting. Another criticism is that it is self-fulfilling prophecy. Who can explain that self-fulfilling prophecy? It sounds like an English word, but maybe you can link it to this. Who can help me with this? Self-fulfilling prophecy. If you say something is self-fulfilling prophecy. Prophecy. Anyone to help? Edupoku, you want to help us? Self-fulfilling prophecy. Who can explain it? Okay, Andres.
Okay, so here I is where there is, let me say, an assumption that a particular stock, let's say for example MTN, we assume that MTN shares will go up by, let's say, 5%. So all of us will tend to focus on MTN shares and buy it. So because it is going up, we are all channeling our attention to that side. And I think that is the self fulfilling prophecy, where there is an increment, we all channel our attention to that type of stock and then move towards that direction.
That's exactly the criticisms they are putting up here. Thanks so much. Okay, another critique point is that technicians often act too late to be able to take advantage of the self-fulfilling prophecy situation. But by the time they have processed the stock price information and acted, other technicians will have done same, and the stock price will have reached its new equilibrium, and it will be too late to make trading profit. As I said, we all channel ourselves to the same direction, and you know what happens when demand and supply comes in. See, if there is more demand, you know what happens, and if there is supply to is higher, you know what happens. So if we are all pushing our attention to the same direction, you know what happens, right? Okay, so the final criticism deals with the difficulty of discerning chart pattern as they develop. Okay, let's move to there. So we have the fundamental analysis as well. So we looked at the technical analysis. So the fundamentals are weak, what happens? So the
exchange rate the exchange rate will expose you.
Good. So you are going to look at the fundamental analysis. Now, you are not looking at technical analysis. You don't base on technical analysis to make this. You base on the fundamental analysis. So what then do we look, or what do you mean by fundamental analysis? So the fundamental analysis uses earnings and dividend prospects of a firm, expectation of future interest rates, and risk evaluation of the firm to determine stock prices. They don't base on charts and graphs. They base on earnings and dividend prospects of the firm to determine whether the firm is going to pass based on past earnings to determine how it's going to be. So this one, they based on balance sheet, evaluation of the quality of the management of the firm. Okay, so if the management of the firm is not quality, it means the fundamentals are weak. And if the fundamentals are weak, you'll be exposed. Okay. All right. So to determine the value of a firm, fundamental analysis relies on long-term or long-run forecast of an economy, one, to the industry and also the company's financial prospects. So we are looking at the real figures of the firm, not what is happening on the market. So fundamentals, we are coming to the grounds. What is happening on grounds? Based on that, you can make prediction of what is going to happen. We have two main types of fundamental analysis. Okay, and based on the level, fundamental analysis is conducted on three main levels: the economy as a whole, that is the global and domestic, two, the industry level, and also the firm level. You know, the economy is the highest, the industry comes next, and firm specific level. So these are the main three levels of the fundamental analysis. All right. So when it comes to the analysis, it can be done in two ways. The analysis can be done in a top to down analysis. If you say top to down, you start from the top. So maybe from the economy, you analyze it down to the industry, down to the specific firms. Or if you want to start on the specific firms and see how they contribute to the industry and also the economy as a whole, then you do the bottom up analysis. So that is the main two type of analysis that can occur in all these levels. All right, so the top to down, I've even explained it already. I wanted to ask you, but I've explained it already. So it starts with the broad economic environment. It examines the state of the aggregate economy and even at the international level as well. So after analyzing the broad economy, the analyst will move the analysis to the industry level, as I just said. So looking at which industries are best positioned to be successful and profitable given the economic situation. Then finally, the firm will position with the industry to examine by looking at which firms within the industry will maximize investment return before they make any investment decision. So they do the fundamental analysis to predict which industry is performing well at the economic or at the international front and which firms belongs to this industry before you make such an investment in these industries. Okay, so who can explain the bottom up? I know you know, so just explain it and let's go. So it begins at the micro level, the firm's level, expands the analysis to the company or the industry or the sector. Then it will go up to the economic as a whole or the international front. Okay, so the top-down analysis must start with the global economy. So that is the international economy might affect a firm's export prospects, the price competition it faces, and also from imported goods. So the global environment presents political risks of far greater magnitude than is typical in home base. So as a business or as an investor, if you want to go into a global economy when it comes to investment, you have to consider the political risks that you are exposed to if you want to make an international investment. You know, going beyond your borders, it's also form part of the global economy. But the global does not only limit to your home country, it can go international. So you have to know the risks you are exposed to. So political unrest or maybe geopolitical risk is also another geopolitical conflict. All those are points that must be considered. So the global environment may present a business opportunity for firms. It can also present threats when you don't do analysis well. Because political risk is one of the major risks that affect businesses in the international front. All right. So imagine you invest in crude oil. Okay. So looking at this Russia-Ukraine war that happens, crude oil prices are mostly affected because of the countries involved. So all these are political issues or political risks that businesses are exposed to anytime they go good. Example, this is a perfect example. So currently the oil and food price increase being experienced all over the world have adversely affected the operations of all firms. This is because the oil crisis has increased the cost of energy. This is exactly what I was even explaining. I didn't even know it's in my slides. So since all firms use energy in one way or the other, their cost of operation will also go up. Because if the countries that supply them with this crude oil are at war front, it causes a lot of tension in the market. It causes chaos. We call it chaos in the market. Okay, exchange rate is one of them. We also have the domestic economy. So there is a relation between stock price and economic activities. As a result of economic prosperity results in higher values of stock. So the economic environment, whether the domestic also has a higher influence over the performance of businesses and individuals. Okay, so at the domestic economy, so what do you think are some of the things that can affect a business? If you want to analyze the domestic economy, what do you think are some of the things that must be considered? GDP, GDP, the gross domestic product, the gross national product, all these, I'm sure you are familiar with them. Employment, employment issues is one of the things that must be considered when you are doing analysis at the domestic front or the domestic economy. Employment. The employment rate of a country is the total labor force yet to find job. So it measures the extent to which the economy is operating at its capacity. So when people are employed, their purchasing power goes up. Therefore, in a country where the rate of unemployment is low, all things being equal, demand for goods and services is expected to go up. So as an investor, if you want to set up or make an investment at the domestic level, in country level, you need to consider the employment rate in the country. Are the citizens having jobs? Are they having source of income? Will they be able to patronize my services? All these are some of the things you need to consider whenever you are picking. So you have to consider the GDP too. So a country that has a higher GDP, it means that the economy is doing well in terms of GDP. Employment rate is high, unemployment rate is low. Because if unemployment rate is low, it means that the purchasing power of individuals is also high. The majority are working, so they have a source of income. And as such, they will be able to patronize your product or invest in your business as well. Inflation is another thing. Inflation. Who can explain inflation? Why do you think inflation must be considered when doing domestic economy analysis? Inflation. Who can help? Inflation. What happens when there is high inflation? What happens? All right. So the rate at which the general level of price is rising. So when inflation is high, we term that the economy is overheating. So it means that demand will exceed supply. Inflation may impact negatively on the operations of the firm. Okay, interest rate and sentiment, investor sentiment. investor sentiment. So it talks about the confidence that investors will have or consumers will have in your business. Okay. If they have confidence in you, they'll be willing to spend more in your business. Also, if they have confidence in their future income level, it boosts their purchasing power. Yeah, imagine when someone promised to give you 1 million Ghana cedis the next month, even though you've not received the money, but your purchasing power has automatically increased. And in fact, you start spending the money in your mind before you even receive it at hand. Everybody has done it before. Who can tell me that the person has not spent monies here to be received before? I'm sure some of you, someone has even one way or the other has promised you some money. You've not yet received the money, but in fact, you spent half of the money already. Erasmus, is
Exactly.
it true?
A long time. The CPD
Good.
money has been sent or spent
Say you
already.
are right too.
That's it. So when consumer sentiment, optimism, and pessimism, okay, it boosts your spending or your purchasing power. You have confidence about a rise in your future income, and as such, you tend to spend more. Okay, monetary policy to fiscal policy, they all influence there. Right. Let's also look at the industry analysis. Now we've looked at the economy. Now about the industry. So that's the second step in the top-down analysis. Okay. So here we are going to focus on the industry life cycle and also the industry growth. Right. The particular phase in the life cycle of an industry determine the growth of earnings, dividend, capital expenditure, and also the market for aid demand. An industry analysis helps place an industry on the life cycle curve. You know the life cycle, the growth stage, the peak, and all that. So an industry analysis helps place an industry on the life cycle curve, and in turn, it will guide the analyst towards decision on industry growth. So the duration of growth, profitability, and also the potential rate of return. Okay, so at the industry level, we look at the growth in the industry, the growth or how the industry is booming. That is it. Whether it's at a recession or the booming or is in the normal business condition. So the life cycle of an industry, you have five main stages. You have the development stage. You know this already. I know definitely you've done it. Management, development, growth, expansion, maturity, and the decline stage. So these are the main. So at the development stage includes getting started in the business with new product development. Okay, or bringing out a product that makes the business unique. So at this stage, it will be difficult to predict which firms will emerge as industry leaders because we are all at the development stage. So we don't have any leader, a market leader or follower in the industry. We are all developing. So some firms will turn out to be successful and others will also fail altogether. So there is a considerable risk in selecting one particular firm within the industry if all the firms in the industry are at the development stage. So we need to consider the cycle or the stage in which the industry finds itself. The industry you want to invest in the economy. Now you've done the economic stage, you've looked at the unemployment and all that. You've come to the industry level. So you have to consider the stage in which the industries are in. Are they developing? Is there an expansion in some industries? If you want to invest an industry that is now developing, there is a high risk that the business will not perform, or there is a low chance that the businesses will collapse. Okay, so we have the growth stage and also the expansion stage. So at this stage, this is where the industry leaders begin to emerge. The survivors are more stable, and as the market share is easier to predict. But now they are stable and you can easily predict the performance of the business in the industry. We also have this stage where the business has reached its full potential. The business has matured, it's at the maturity stage. the product has become standardized and producers begin to compete on the basis of price. So the automobile industry is a typical example of mature industry, automobile industry. Okay, so all these are the growth, the cycle of the business that you need to consider. Okay. So the structure of an industry is also another area of importance for the analyst. Industry structure. Industry structure determines whether the companies in the industry are profitable, whether there are specific considerations such as maybe government regulations that might positively or negatively affect the industry, and whether there are cost advantages and product quality will create a dominant company within the industry. So factors to consider under the industry structure are the economic structure, government regulations. If there are any government regulations, maybe some prices are being regulated by the government, and as such, you need to consider how the changing regulation can affect the performance of this industry. And also competition, that is the competitive structure and the threat of entry. Is it easy for people to enter into the industry? Can somebody just set up a business, or can somebody just enter into this industry without much or with much flexibility? All these are points you need to consider, because monopoly can never be there always. So you have to consider the threat of entry anytime you are investing into an industry. All right, so government regulation is example, some of the things. So the food industry is regulated by the Food and Drug Board. So what are the regulations if you want to go into beverages, if you want to bake in food items, or if you want to go into the food industry? What are some of the regulations that may affect your business? So you have to understand how each industry operates and know how government regulation can affect your business. All right, threat of entry, I've already explained it. All right, so the company analysis, now we come to the firm specific level. So you start from the global, the economy, and also the global, the industry, and also the firm specific, that is the company analysis. So it involves the analysis of the firm. So some aspects of the firm will have to be analyzed. So you have to look at the managerial monitoring when it comes to corporate governance issues, ownership structure, who owns the firm, and also the financial statement of the firm. How is the firm performing in terms of finance, or in terms of financial? What is the financial strength? What is the financial position of the firm? All these are points you need to consider when you are analyzing or you are performing your analysis at the company level or at the firm specific level. So managerial monitoring. So when it comes to public companies, ownership is separate from management. Okay, there's a separate legal entity, that's the right word. So there's a need to monitor the activities of management to ensure that management will act in the best interest of its holders, shareholders, the owners of the business. So managerial performance is monitored inside the firm by the board of directors, who hire and oversee management. So you have to consider the managerial monitoring. Is it a separate legal entity? How is the management structure? Ownership structure is also another point. The amount of capital or equity that is owned by managers, board members, institutional investors, and the widely spread investors. So you have to consider the percentage of insider equity financing receive the most attention. So when it comes to profit sharing, debt holders who receive their own, or they are the insider equity financing, they will receive the most attention. So the amount of equity that is being owned by the CEO, top managers, the board members, and employees of the firm of the organization. When it comes to firms, shareholding is very important. Okay, your voting rights can even be based on your shareholding percentage, whether you are just a small shareholder or you are the gurus in the firm. Because when it comes to decision making, the more you're voting right or you have more votes, that is when your voice is being heard. When it comes to meetings, annual general meetings, and decision making, the higher investors, those with the higher numbers, are the ones that their voices are being heard. All right. And also the financial statements. So with the financial statement, you can look at the ratios. Okay, you can use the ratios, equity profitability, efficiency ratios, liquidity ratios, and investment ratios to determine how the business is performing in terms of the industry. I mean, in terms of the financial performance. So profitability. So we have the return on equity. So we are here again with profitability ratios. I'm sure you've been doing when you did business analysis or business finance, business evaluation, you did all these things. So return on equity. So the earning before interest and tax, that is EBIT over the net assets. We have profit to turnover ratio, EBIT over turnover. All these are profitability ratios. Gross profit ratio is profitability ratios. So earning per share, that is the profit after tax over the number of shares, number of ordinary shares or number of common shares outstanding. All these are profitability ratios. So all these ratios help you to analyze the firm specific or perform a firm specific analysis in the industry. So you've done the industry level, you've selected an industry, but when you enter the industry, you have different companies operating in the industry. So in order to settle on a company, you need to know the financial performance. What is the financial position of the firm in the industry? All these ratios will help you in calculating the efficiency ratio is there. So on the efficiency, we have the fixed asset turnover, that is sales over fixed asset, capital turnover, stock turnover, average stock over cost of sales. We also have the average account receivables over sales times the number of days, which is 365 days in a year. So all these are ratios you need to consider anytime you want to perform the financial analysis of the firm. In terms of liquidity, we have the current ratio, which is current assets over current liabilities. Quick ratio or asset test ratio, that is the current assets minus stock over current liabilities. Gearing ratio, the long-term debt over total debt, that is debt plus equity, or total capital, that is the debt plus equity. It's not difficult, when it comes to investment ratios too. So all these are the, when you want to evaluate a firm, okay, when you want to do firm valuation, these are the ratios you consider in terms of investment, in terms of liquidity, in terms of efficiency, in terms of profitability. You have different ratios under each of them. Okay, so in terms of investment, you have the payout ratio, the equity dividend over equity earning. In terms of PE ratio, you have the market price per ordinary share over the earning per share, the EPS. The dividend yield too is the dividend per share over the market price per share. You also have the net book value per share, which is the net book value of ordinary shares over the number of ordinary shares. All right. Now, what is efficient market hypothesis? Have you heard of it before? Efficient.
Hello, sir.
Hello.
Sir.
Andrew.
Doctor. Yes, yes, Papa. Hey, sir, the ratios. What do we expect from there? You didn't do any example.
Okay, so as I was saying, they are showing you in case you want to perform a firm specific analysis to know which firm is performing well. Okay, you've done business valuation before. Sometime in a question they can give you the financial statements of two firms, okay, in order to depict their performance. So in terms of ratios, how do you determine which firm is performing well? Okay, so when you are analyzing the financial statement, you cannot just look at okay, let me just look at the gross profit of the firms to see which firm is doing well. Because some firms may have more expenses than the other. All right, so these are some of the ratios you use in your analysis to determine which firm is doing well in terms of profitability, in terms of investment, in terms of liquidity, and even efficiency. So that is the sense of the ratios in order to help you analyze firms in the industry. Okay, so in your journey, did you do any project whereby you were to choose maybe a firm on the stock exchange, maybe two firms, and perform maybe a trend analysis of the firm to see how the firm has been performing for some years based on some of these ratios? Have you come across anything like that?
Yeah.
No, sir. I think you were given balance sheets and I think trading profit and loss accounts and balance sheets. Then they asked us to maybe find the rows, those things. They gave us some ratios to calculate it.
So they give you the industry ratios and also some ratios to
Yeah,
compute
yeah,
how
to
they are
calculate
performing
it.
in the industry.
Yeah, then after
Yes.
that, they
You
gave us
analyze
to write a report. Yeah.
the report. Yeah, that is exactly. That is how you perform the analysis. So you are all analysts. Then you have to explain to me now. So in terms of profitability, the one with the higher ratio is the one that is deemed to be performing well in the industry, comparing to the industry ratio. So sometimes they'll give you the industry ratios, then you perform the firm specific analysis and you compare to the industry ratio to write your report to see if the
Yeah,
business is performing well in the industry.
yeah, what say please what my brother was asking was that in the ones that we did for the advanced accounts and those things that we did, we're given the trading profit and loss account and the balance sheet. Then we're
So,
asked to find those ratios.
okay. So Andrews,
Yes, Doc.
so you're asking that um I've given you ratios, but you don't know what you are using the ratios for if I'm to get it right.
So I'm
Andrews, yeah,
asking you.
yes. But do you understand what you are saying? You see,
Yes.
lucky for you, you have done even some of the analysis before. So, whatever I'm saying is something you've done before. So I thought I'm even exposing you to it, but you've even done it before. So those are some of the reasons why we compute these ratios in order to determine the performance of the businesses as compared to the industry. Okay. So not really trying to do a practical example to,
Okay.
to buttress it. Yeah.
Okay.
And
So
even if there is anything like that, it will not be new from what you've already done. Okay, they giving you financial statements, giving you some specific ratios to compute and write your memo or report but we are not going there. That is not the focus. But we are looking at how firms perform the analysis, the things they consider at each level. If you are doing the analysis at the economy, you consider the GDP, you consider employment rate. All those are the things one consider when they want to invest in a particular country. When it comes to the industry level too, we looked at some things you need to consider, inflation and all that. And this one is the firm specific. If you want to invest in a specific firm in an industry, you compare the performances of these firms. So how do you know the performance? So you can build financial statements. That is another thing. Just to know how a firm is performing. That is it. So that's the focus of. Andrew, are you there?
Yes, dog, I'm here.
Right. I hope it's okay.
Yes, dog. I'm fine.
So, what then is efficient market hypothesis? I know you've heard it before. Nifty,
This one I
efficient
don't
market
know.
hypothesis. Hey, you've not heard it before.
Yes, sir.
Erasmus, is it true?
Yes, sir. This is the first time I'm even hearing this.
Hey! Oh, wow, I see. Wow. Okay, so let me see. Who else do I have in the list? Some people have never spoken here before, and we are ending the lecture. Since day one, they've never spoken. Okay. Godfrey. Godfrey, you've never spoken in this class. Godfrey, are you there?
Yes, sir. So I'm around. I joined
Godfrey,
later. That's why.
Godfrey, you've never spoken in this class before.
Yes. Mostly I always join later. That's why.
Okay, so today may be our last meeting. So tell us, how do you understand efficient market hypothesis? Have you heard it before?
No, sir. But I've heard of market before and then efficiency too.
Okay. So what is efficient? What is market?
Market is a place where buying and selling take place.
Okay. And efficient talks about
Like how frequent an incident happen.
and hypothesis.
Hypothesis. Is that like giving analysis?
Giving analysis. Uh-huh.
Uh, I can continue for now.
Hmm. So yes, as you said, you see, one or the other, you may have an idea. You have to put them together. Okay. So when investors buy equity, they undertake perpetual investment since equity has no maturity date. I'm explaining something. They encourage investors to make such commitment. They should have the assurance that a market exists. They could sell their shares at a fair price. So anytime an investor wants to make an investment in a particular firm or a product or a stock, they should consider there is efficient market. Efficient market means that there is an available and readily information. Whenever you want to buy or sell, there is an ready market. There is a market where prices are fairly determined. There are market information available to determine the prices. That is what is meant by efficient market. If you say a market is efficient, it means that price of shares are efficiently incorporated and there are all information available about the company and also the economy as a whole. Okay, so the notion of efficiency is therefore not only important to investors but also company managers. The efficient allocation of resources is an important determinant of economic growth. So when there is an efficient market, businesses tend to get a fair prices for their products. An efficient capital market is the one which prices of traded securities always fully reflect all available information. Yeah, this is exactly what I say. Where prices of securities reflect all available information. So you can easily know the price because you know what is happening on the market. You know what is happening on the market. So a capital market is therefore efficient if it does not neglect any relevant information to the determination of security prices and also rational expectation. It reads the information correctly. You see, that is why I always talk about the CD and the dollar. You see, even um, there is a word, investor sentiment, information alone. Information is very powerful when it comes to the security market. You see, in Ghana, you see, some of us we watch American movies, whereby maybe um, a firm or an industry there's a red notice on maybe a manager of a firm. automatically the share performance or the performance of such firm drops because investors begin to retrieve their share, they begin to sell their shares of the firm, and as such, it reduces the value of the share price of the firm. So information is very powerful when it comes to trading. Information is very powerful when it comes to trading. So when there's an efficient market, all available information are used in the determination of price. So a little information can make or make a business. All right. So the basic intuition of efficient market is that individual traders process the information that is available to them and take positions in assets in response to the information as well as their personal situation. So I think all these are explaining what means by the efficient market. Okay, so we have three major forms of efficient market. We have the strong form, the semi-strong form, and also the weak form. So when it comes to the strong form, it goes beyond the semi-strong, logically that is it. So stock price reflects not only all public information, but all information. That is, a market is strong from efficient if insider information is also fully incorporated in current prices so that no investor can earn excess return by the use of trading rules. So when it comes to strong form of efficient market, it means that even though the market is efficient, the available information to determine, but insider information is also used to determine. That makes it strong. So maybe, okay, even though company A, their share price has been dropping, their profits for the past 5 years, they have been making losses. Hmm. It seems the company is going to collapse. But you see, one manager in the firm can come out and give an insider information to somebody that they are going to close down the firm in the next few months. This information makes it a strong, efficient market because there is an insider information that can help in when it comes to price incorporation and also trading. Unlike the weak and semi-strong, major research results are supportive of the strong form. But is it always good to base on insider information to make business decision? Is it always good?
No,
Okay, why? Help us. Why? Why do you think it's not good? In some parts of the world, insider information is a crime, and you can be arrested for that.
Okay, so I have a question here.
Okay.
So say, uh, I want to buy a share or a stock from a company. This insider information which has come, I want to find out, is it always the negative insider information, or sometimes too, when a business is doing well, the insider information can also come so that you can make business decision?
It can be good and bad. So let's take an example of the good side. Maybe the firm intends to increase dividend payment in the next 2 months. Do you think it's a bad insider information or good?
It's good. It's good
And
to
what
share
do you
with the
think will
customer.
happen to the performance of the shares of such company? People will begin to invest in them because of the possible rise in the future dividend. Even though it's not something that is publicly known, but because somebody has a lead information, the person gave you such information and you reacted or you based on such information to make such a business decision. Okay, so we call this price sensitive information. It helps people in order to earn abnormal return from their investment because this information will not be quoted on the face of the annual report, something like that. Do you get it?
Yes, sir.
So in some part of the world, insider information is a crime. As a business or as if you leak such information to investors, and they treat it as a crime. Okay. All right. So another research has shown evidence that insiders do have what is called information advantage. Good. That is how we call them, information advantage. This means that they are able to use this price sensitive information to earn abnormal return from their investment. Using insider information is known as insider trading and it's a crime in many countries. Insider trading is a crime in many countries. So when it comes to a semi-strong form of efficient market hypothesis, it maintains that all public information is impounded into the value of a security and therefore one cannot use fundamental analysis to determine whether a stock is undervalued or overvalued. Therefore, a market is semi-strong efficient if all public information, that is the company annual report, newspapers, dividend declaration, is fully incorporated in the current price of the security, so that no investor can make excess return based on this information. So with a semi-strong, all information should be based on the technical analysis to determine, the future was performance or the future price of such firm. You based on the technical analysis. That is what they are saying. You based on the charts and the graphs, because everything, those ratios or those graphs speaks to the performance of the company. It speaks all about the company, and you don't need any insider information. That is what they are saying. And of course, you also have the, okay, let me read. Therefore, the semi-strong form is considered with whether current price of security reflects public knowledge about the underlying company and whether the speed of price adjustment to the public is fast enough to eliminate the possibility of abnormality. A number of researchers have shown consistency with the semi-strong form of efficiency. Okay, this includes former et al., blah, blah, blah. All right, so the weak form of efficient hypothesis also state that security prices fully reflect information regarding the historical events, that is the past prices, return, and also trade volumes. And investors knowing the historical sequence of prices can neither abnormally enhance their investment return nor improve their ability to select shares. So this one is based on historical information, not the forecasting based on chart and graph, but based on historical. Even though we based on historical information to predict the future, right? But mostly the information is centered on past or historical information. And you cannot make abnormal profit based on historical information. That is what they are saying. So this is a weak form of information in an efficient market. So we have the strong one based on insider trading, the semi-strong that based on technical analysis, and also a weak form of hypothesis. All right, so I wanted to get here before we see how we are going to. So before I start, I asked you, is there any question from our previous meeting? I think nobody answered to that, so some people were not there. This may be our last meeting, that is why I'm asking, so that we know if there's anything for us to address. If there's anything you want to know to them, see how best to go about it. So is there any question so far for today's section? If there's no question, then we jump to previous section if there's any question there. Please speak, oh, speak. It's your time to talk now, so talk.
Sir,
Yeah,
in
listen.
the calculations, we saw that most of them were wrong, and I don't know if you have checked it for us.
Come again.
I think the calculations one, most of the answers in the slides were they are full of mistakes. So I don't know whether you are aware of that one. That was
Yes,
because
I'm
sometimes when
aware.
you okay. So sometimes when you solve it, you want to compare with your own to see whether we're on the right track or what. But you realize that some of them are not. Uh,
No,
in,
because
in,
the questions is more of I use the same question to set for most of the examples. And I think
okay.
in our previous meeting, I made it known that there are some mistakes somewhere. So I want you to try it yourself and confirm the figures if it's right or wrong. I don't know if you remember, I made a comment like that some time ago.
Yes.
Andrew, do you remember?
Yes, sir.
So I don't want you to rely on the figures. I want you to solve it yourself and compare. Maybe you have someone who has done it. You have a page. I remember I gave you some practical questions to solve it. Nobody even sent me the solution to check whether what he did was right or wrong. So I presume you've all done it and you are okay with it. So in case you meet it anywhere, I know you can do it, right?
The which of them?
I don't know, Gifty. I remember we solved a lot of questions. But I gave you some questions to try your hands on.
Yeah, the last time you came, we gave it to we tried solving it and you explained things. So I don't know the one that you gave to us
Oh,
that you
okay,
couldn't.
okay. So we explained it the other time.
Yes.
Okay, then I may have forgotten.
And say
Yeah.
uh the question you see that we solved it in batch bit by bit. You see, so is
Yeah.
it going to be like you are? Let's say because if you look at some of the question that I solved. It's like they have given, they say you should calculate the expected rate. That one, that if a project A and B are combined in the ratio of blah, 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 blah. But if you look at the solution, it involves the expected return, variation, then come to co-variation and those things. So I don't know how the question will be. Is it going to be one question? Then you have to find all those things inclusive.
Even if it's one question, you ask yourself, what is the requirement of the question? Okay, if it's one question, this is the formula. What are the components of the formula? It means you will need this, you need that. I hope you get it. Even
Okay.
if you are calculating for variance or standard deviation, you will need expected returns, right? It means you have to calculate the expected return first. If this is if in a ratio, blah blah, it means that you are heading towards portfolio. It means you have to determine the expected return of the portfolio as well, standard deviation of the portfolio. Okay, so based on the, I'm not sure they'll give you one question that maybe calculate the coefficient of determination or something. They will tell you to find the expected return of investment A and B, maybe expected return of the portfolio, standard deviation. So it always starts from the individual to the portfolio. You cannot do the portfolio without doing the individual first. Because the portfolio is the individual coming together to form a portfolio. I hope you get it.
Yes,
So
sir.
if the question even tells you to find the standard deviation of the portfolio, first of all, you have to find the standard deviation of the individual investment. And for you to find the standard deviation of the individual investment, it means you need to find the expected return of the individual investment because you need it in calculating for the standard deviation, true or false.
Yeah.
So sometimes the question follows sequence. That is why I was being emphasis that you start everything from the expected return. So you have to always be careful with your computation because if you make a wrong move, it will follow you to the end of the question. Yeah, if you make one wrong move from the top, especially when you are calculating for expected return, if you are wrong, it means that it's going to follow you to the end. Because you are going to use the wrong figure to calculate for your standard deviation, your variance to the end. Yeah. So it's not difficult. Just know the formulas to use. Expected return, how do you calculate it for expected return of individual? How do you calculate for standard deviation of of individual investments? How do you calculate for variance of the individual? How do you calculate for expected return of the portfolio? Standard deviation, variance. So you just have to know the two and know how best you can go. I hope you get it, Guti.
Yes, sir.
All right. Any other
Sir,
question? Okay.
sir, too. How is the quiz going to be in the end of since we are not meeting you again?
How do you want it to be? Tell me.
Okay, so sir, here
So,
let me also come in small. It's very important. Sister Gifty, thank you. Sir, I want to verify. We have done, I think, one unit I didn't see is unit 3. I don't know whether it is embedded in one of them.
Yes. Three of the slides, you see them. Chapter 1 and 2, I think I use one slide.
Okay. So, Doc, from which unit to which unit will be for quiz 1? And as she asked, exam 2, so that we prepare towards that line.
You might get maybe one practical question.
Sorry, sir, your
we
voice
can
is
hear
not
you.
coming.
We can't hear you.
Go ahead. I say you may get a practical question. Or maybe it's not going to be.
So
your voice
so we
is
can't hear you.
can
Can you hear?
Hey, it's now okay.
Okay. Right. So it might be a practical question. Maybe just one practical question, as Sister Gifty was saying. That maybe just have to, go through, or maybe some written aspect. It's not going to be multiple choice as for that one.
The quiz. Oh, the quiz will end of sem.
Quiz and end of sem.
Sir, the quiz is 20 minutes, and if you are going to do it practical, by the time we finish calculating one question, the time will be up.
What if it's just one question?
Hey, online.
Online.
Are you doing the quiz online?
Yes.
Yes, sir.
Okay, so you prefer multiple choice.
The voice is not coming.
The voice is not coming.
Hello.
Yes, sir.
I'm very loud. Hello.
Yes, sir. Yes, sir.
You said you're writing the. Joseph, your hand is up. Joseph Akobri, your hand is up. You want to say something? Now, to Joseph, your hands are up.
Hello, Doc.
Yes, sir.
Good evening.
Good evening.
I thank you for taking us through right from the beginning up to the end. But as it stands now, I think this is our last semester. And if one is not able to pass, it means that you will not go for graduation. So we are pleading with you as your student to help us with maybe areas that we can learn. Because as it stands now, we are combining work with studies, and it's not easy. So this is my humble request on behalf of my colleagues. Thank you.
See, if you are very participating in the class, whatever you need to know, I've given them to you already.
Sir.
Yeah,
Sir, actually, it's not like we are asking you to do it, but what we are pleading is that maybe the end of sem, maybe chapter 1, one question will come from there. Maybe portfolio.
Okay, with that, I think maybe with time we can communicate on the platform.
Okay.
I'm here to agree on that.
Okay.
So I hope you get it. I cannot determine. I can't give you areas here. What if I even forgot that I give you this area?
Okay.
So maybe after I'm done, then I'll let you know where I think you should.
Okay. Yeah. All right. Thank you. But we really appreciate your. We really appreciate And so we thank you. You have been of help. Actually, your patience and the way your teaching has gone throughout. We really appreciate it, and we would love to meet you again in our next, maybe when we are doing the masters. Maybe.
Yes, I don't
I
know. So
appreciate it. God bless you.
I always reach out. Okay, man.
Yeah, yes, sir. Evans, please, the assessment task we are having quiz 1, end of same exams, and quiz 2. And the quiz 1 is actually MCQ questions. That's online for 20 minutes. That's the base assessment for the quiz 1. The quiz 2 is actual end of same exam. That one can be whether practical questions or if MCQ is, but then the quiz 2 is online. That one too is actually MCQ question. That's what I want to draw your attention to.
Is it always the case?
We didn't hear.
You mean, is it always the case the quiz is NCQ?
Yes, please.
For the
Is it
first
always
quiz, yes,
multiple
sir.
choice?
Yeah, the first and the second quiz.
So both quizzes are multiple choice.
Yes, sir.
Yes.
Because last year I didn't give them multiple choice. That's what I'm saying. All right. So I will take all that into consideration. Then. Let's see how best. When are you supposed to write the quiz?
Next 2
No,
weeks.
yeah, next 2 weeks.
Next 2 weeks. So we are writing all the quizzes next 2 weeks, or how is it done?
We take quiz
Yeah,
1.
next 2 weeks, Saturday and Sunday. The quiz 1.
We take quiz 1. Then we take the exams, and then we take quiz 2. So quiz
Quiz
2
1.
is after the exams.
Okay. Quiz 1 is when?
Next 2 weeks.
And the same next 2 weeks we take the exams. Is that what you're saying? Or
The following
So
week after the quiz.
the first quiz is 2 weeks from now. Then after the first quiz, the following week or the following 2 weeks, we take the exams. Then
It's the
after
following
that,
week, not the following 2
It's
weeks.
the following week. It's the following week.
no, the
all right,
following week we will take the first quiz. Then the
I'll check.
subsequent week
I
we take the second quiz. Then
have the timetable, so I'll check and see.
The quiz
So
is the
Exactly.
following week. We use 2 weeks for the exams.
that's fine. So I'll get ready on that. So if anything, we are on the platform, we can talk there. You have my number too, so if anything, you can reach out.
All right. Thank you, sir.
All
We
right. So I
appreciate
think
you.
you're welcome there. I think we can end here. Any further discussion can be done later.
Okay.
Right. Nice.
Yeah,
Are we meeting
yeah, that's
again?
the why.
Come again.
Yeah,
So I
that's
was
the
asking if we will meet again.
You want us to meet again?
And sir, when
For
we have any
revision.
difficulty, we'll arrange with you, then you meet us.
That's fine.
Okay.
You can let me know and I'm going to also prepare on that.
All right. Thank you, sir.
All right. You're welcome. Okay. So thanks to you all for your time too and your attention. Hope to see some of you again. All right. Enjoy your evening.
Sir, before
Sure,
you
Doc, you
sign
will
out.
see us one day.
Sir, before you sign out, where can we locate you?
I'm in Kumasi currently.
Sorry?
I'm in Kumasi now. We have a new campus here, Kumasi, Kumasi. So that is where I am currently.
Oh,
But I'll be
okay. And
going to the campus almost every week. So
very sure why.
that's it.
I
Anytime.
mean,
Yeah.
Bye bye, sir.
All right. Bye bye.
Bye.